did have a question come in this week. I had one from Mikhail and also from David, different David, David B, not David that sent in the question by email. But their question was on the proper time to roll an out of the money covered call. Okay. And we had discussed this topic before. Let me see here. I'm just trying to search for something here. Oh, there we go. All right, so I went over to the YouTube channel here. There's one there, to roll or not to roll OTM covered calls. There's someone in the money, rolling it deep in the money, went to rolling in the money. There's another one here. I think I wrote out of the money, but there's the recent one here, 6 months ago, to roll or not to roll OTM covered calls. But Mikhail, and I believe it, David B's question was a little bit different. And their discussion was more on, when should I consider rolling an out of the money covered call? In this case, let's see here. Let me go back to April 28th. To keep the most premium. This is a very tough question, in my opinion. What are we talking about with an out of the money covered call? We're going to build this one as well. We're going to look at the May 21st 65 call, cough, cough. There's a reason we're going to look at that. On April 28th, we knew the stock was trading at $62 per share. At that time, if we had sold the out of the money May 65 call, probably would have generated about $1.10 or $1.20, something along those lines. Oh, it's worse than I thought. Okay, 95 cents. It's not going to be a bad return. But in this particular example, I thought it was appropriate for what the questions came in from Mikhail and David, because they wanted to know when is the best time to buy the callback so you keep the most premium, you keep the most credit that you initially received. We've already seen what Barry did. And so looking to answer that question, when it would be the best time, if I had entered this covered call, let's go ahead and enter this covered call into our portfolio here. We'll keep it on the May 21st. And we're doing BERY. Very familiar with this stock because unlike David's question, I did do something, unfortunately, with my married put, which is the January 65 put, bought at different prices. The stock was at $60.93, and I bought the January 65 put for around $9, I think. And I'm sorry, 62. And I did sell a call and got caught with it. So when the stock did move up to 63.96, we sold the May 65 call, and with that sudden run, there was just not a good time to buy it back. So I ended up closing it today for almost intrinsic value of $570 or $560. And it wasn't the best structure. I did just roll it, but I haven't been able to roll the put yet because my put wasn't filled. So I'm going to cancel that risk there. Not cancel the risk. I'm going to lower the risk back down to normal ranges after I roll the put. Okay, so this is good. It had the potential of a 6.5% return on the position where we would have been today at expiration. This would have been an out of the money call, much as David and Mikhail were asking. Bought the stock at 62, sold the out of the money 65 call for 95 cents. Now, real quick, I'm going to go to the research tool and call research. And this just shows you all of the basic data we have for the option, including the Greeks, IV ranges, percent IV range, and more. And right now we're comparing it. The option bid is the red price, the red line here, compared to that. But I'm going to compare it to the stock price. Okay, so it was originally option bid in IV. We're going to compare it to the stock price. Let's go back only to April 28th. There we go. And you can see right here. That's when I sold the call for 95 cents. As the stock moved up, the call premium never came back down to 95 cents. Here's the stock price going up to 64. It's not even in the money yet, and we're essentially here at $1.50. So that's a 50% gain on the call premium in this case. And the stock kept going up with a couple dips in here. Now, at this point, probably right about here at this inflection on 517, when the stock is trading right at about 70.50, and the call premium is right at about 560, 570. This is pretty much when the call hit almost just to intrinsic value with a delta of 1. Okay, but we only took in 95 cents. It was going to cost us 550, 560, 570 to buy it back here, roughly the same price I paid today during market hours. It was about 2 o'clock, I think, 2:30, when I bought to close this call and rolled to the 72.5 for June for only 95 cents. So unless you have a stock that's waffling, that goes up and then pulls back down and then goes up and then pulls back down, the direct answer to Mikhail and David B's question is, when the stock is moving up like this and it's getting towards your strike price, the best time to buy it back to keep most of that 95 cents would have been the day after or the moment after you entered the position. It's going to keep increasing with what? That swell of intrinsic value, the at the money bell curve. You started here with your call at 65, and now the stock is moving up. So that extrinsic value is increasing, and then it eventually goes in the money and it goes lower, but now you've got all of this. That's intrinsic. So you've got the gain in the stock that's being countered by the intrinsic increase as well. So as a general rule of thumb, if you sold an out-of-the-money option and the stock starts to move up, you're expecting your call premium to increase. If you're still lucky enough to be, if you're still out of the money, I should say, at or near expiration, you'll start to get some of the time decay and you look to buy it back. As a general rule, Ernie and I usually look to buy an option back, whether it's a cash-secured naked put, a covered call. We look to buy it back if we've made 80% of the expected profit. In other words, I sold this at 95. I'd look to buy it back at 7 cents, 8 cents, something along those lines. This never got to that. What did get to 7 or 8 cents during the time of this trade? The time value. When you're selling an out-of-the-money call, what are you doing? You're playing a time value game. You're hoping not to be assigned with the out-of-the-money covered call position. Let's say the stock was trading here at 62. We had sold the 65 call here. We got 95 cents. Now what you're doing here is you're playing a time value game. You're trying to maximize the time value and earn, in a sense, a dividend-like income on a month-by-month or every 4 to 6 weeks time frame, maybe even weekly if you're doing it that way. But as we saw, if the stock's going up, the lowest price that you could probably get to buy back the option was the moment you traded it, especially, I know this is an extreme example, and one example does not the market make. I understand that. But again, in this case, their question was, if the stock starts to move up and gets to your strike price, when is the best time to buy it back? And it's when you start to see the time value. Originally, you were here, right? It was about 95 cents or so. Oh, sorry, it was here, folks. 95 cents was the time value for the midpoint price. It went up extremely high. You don't want to buy it back here. But at this point, right as the stock's starting to go above the strike price, the option is extremely expensive. But that's mostly due to the intrinsic gain. Look at the time value. It's down to 32 cents, a third of the original time value you collected. 30, 25, up 51. So now we're at half again. But it comes back now, it's only 2 cents. Remember that crossover that I mentioned, right around 517 or so? It's essentially trading right at intrinsic value at this point. Okay, it's 540, 440, so on, 450, and then 520 again today at the close. But there's no time value. Why am I going through this? Because if you're doing out-of-the-money covered calls to play the time value game, you're not going to, if the stock is moving up towards your strike price, you're likely not going to see a good time to buy it back where you keep most of the premium. That's just not how the way it works, unless you're right at expiration or within 4 or 5 days to expiration. Let's say we entered this position with Barry at 62, sold the May out of the money 65 call, and this movement that we saw up to 70 didn't happen until the last 2 days. So meaning that on Tuesday of this week, the stock was still at 62. Your option might have only been 20 or 30 cents, but your question was, as the stock is moving up, how can you buy it back to keep the most credit? And you saw here that There wasn't. The bid is always higher. But if you're playing the time value game and you're focusing on the time value for what you sold out of the money, you would look for it when the time value is down to its lower ranges. And we show that in the analysis tools for PowerOptions. When you go and you're tracking a married put or the covered call, any strategy really, you can go to position actions, position analysis. This is where we show you the rollout opportunities. We show you the time value left in price. Why? Because in general, we might look to buy back the call if the time premium is less than 0.5%, less than 1%, depending on the structure. If I did a 30-day out call and I got a 4% time value, 3.5% time value, I might use 1%. If I'm selling a 2-week out call and I only got 1.2, 1.5% of time premium, I'm likely using the 0.5% time value rule as a potential target to buy or look to roll that position. Is the option bid going to be higher because I'm in the money? Absolutely. But I did keep the time value. Took in 95 cents of time value, paid $5.40 to buy it back today. But that's all intrinsic. The stock has moved up $8, roughly, $8.39 to give up that $5.40. I think that's a fair trade-off, and I'm maximizing that 95 cents of time value. That's how I look at it. I know not everyone looks at it that way, but we've already seen, and it's a great tool to use. I'm sorry, folks. It's a great tool to use there. There it is. When analyzing when was the best time I could have bought back this call when I sold it for 95 cents if I wanted to keep most of the 95 cents, the answer is you couldn't. It was always higher because of the way the stock moved. But as a time value, you're at 50%, 60% here, a third of the time value here at 32 cents on 5.7 as the stock is moving up. Yes, it's going to cost you $3.20 to buy it back. The stock has moved up much higher. Okay. All right. So for Mikhail and for David, both of them had sent me that question, different emails, and they're not related to each other or anything like that. But they had sent me that conversation, one last week, one this week. So I want to just cover that visually, even though I answered them all as well. That's perfectly fine. I just wanted to admit to everyone here, I did sort of make a mistake on this as well. And I had the 65 calls sold for $1.50, as I mentioned, back when the stock had moved up to 64. And there we go. Now, as you can see, it was in the red. Why didn't I close it before? It's because of that sudden move that it had. And leading up to the earnings, which I never do this. I never leave income method number one open to earnings. I unfortunately did on Barry because the implied volatility shot up so quickly in the 5 days before it. We had collected $1.50, but the buyback cost for that call, I'm sorry, I sold it for $1.50 earlier in April when the stock had gone up to 64 or 63.50. Then it pulled back, and I could have bought it back in April, but then it started to move back up as we saw, and then the implied volatility increased. So when the stock was at 63.95, yeah, at one point I could have bought it back at 95 cents we saw on the 27th or 28th. By the 3rd, a few days before earnings, this price was at $2.95. And then it jumped, and the buyback cost that day was at $3.90. And I said, okay, it's 85 cents in the money, and they want $3.90 to buy it back. No, I'm not doing that. I don't care if it keeps going up. Well, it kept going up, and then it did pull back at one point. The best opportunity I had after that move and the implied volatility to buy it back was here. The 15th, the 9th. All right, I believe it was May 9th when I was first looking to buy it back. So around that time, it did pull back down to about 67.50, and I could have bought it back for $2.80, and I should have done it that time. But I would have just rolled. I would have tried to roll to the June 70, and then I would have had to roll the June 70 now that the stock is moving above that. So instead, I just paid the full intrinsic, a little bit more to buy it back at 5.70. It added to the risk on the position, but we moved up now to the 72.5 call for June with that married put position in the Fusion portfolio. Not the best play. Sometimes income method number one catches you off guard. This one definitely caught me off guard. But as Raymond hinted to earlier, the next step on that Barry position, now that I've bought back the call option and rolled it with income method number two, following the rules in the blueprint. So we're going to play around with that out of the money put now And we're going to roll that up, and we may even shorten the time frame. I may be able, even though I added debit to buy back that call, I may be able to bring the risk down lower to about 3 or 4%, still giving myself a reasonable upside profit potential. Not as much as I wanted because the buyback call, but should be there pretty good as well. So this here, that's the tool again I mentioned. I'm sorry, I went to this here. This is for Ally. And again, I think my call was sold right around here. It was about 40 cents, 42 cents around the 29th during the trading day. And as I mentioned, of course, for Mikhail and Brad, Mikhail and David B, there were opportunities to buy it back, but I got 42 cents. I'm not going to buy it back when it's 27 cents or 28. I was going to look for 80%, the 80% rule. But as the stock moves up, the premium increases. So all of this is buying it back for more. It never went in the money. It was reaching the price, as Mikhail and David mentioned, but I didn't buy it back because it didn't reach the short call strike. Here, I could have bought it back for about 50% gain. Now, I didn't want to do that because the stock here is now down to 51.22, 512. In 9 days, did I expect it to go up another 4 points? Not really. It did. It did move up 3 or 4 points here to 54.18, but then it pulled back those last 3 days we saw last week, and then declines, and it expired worthless. So again, there was no real good time to buy it back. If I had sold it back here at 29 cents, best I could have done was here, about a 50% gain, but the stock was nowhere near the price. The stock was at 46.79. I wouldn't have considered buying back my 55 call at that point. It's here, when now it's more than we originally collected for it, and that's just what you expect to see. This is just enhancing with a different example, both with Barry and both with Ally that was moving around. But that discussion we had for Mikhail and for David about maybe closing an out-of-the-money call as the stock's moving up. How can you keep most of the credit? Again, you're looking at more of the time value than the actual bid price, because the bid price should always be going higher in this case until you get to those last 3 or 4 days. And having a stock decline helps you in that scenario as well. But here, when the stock was at 54.18, we were at 44 cents, about the same price that we had sold it for with 4 days to go to expiration. So that's just another example of what we expect, why it's hard to assume that when I sell an out-of-the-money call of that nature, that I'm going to be able to buy it back at some point or another as the stock is moving up for a lower price than the original credit. That's why I tend to look at the time value rules as opposed to the hard credit with that structure. Not all structures, but with an out-of-the-money call in the form of a married put, out-of-the-money call for just doing a covered call out of the money to collect a dividend-like income. All right, well, it's 5:45 Eastern time, ladies and gentlemen. I don't see any other questions that have come in. So what I'm going to do is just navigate back over now to our slide presentation. But if you have any last-minute questions, I want to encourage you to feel free to send those in at any time. And I just want to remind everyone, of course, that today's material are my thoughts on your questions, designed for educational purposes, increasing investing performance and options knowledge. Any stock or options discussed today should not be taken as direct recommendations or direct trading suggestions. I didn't give Doug direct advice on what I think he should do. I kind of did, where I said, well, you got 56 days to go. If your expectation is, might want to just wait on the position. But we want to show ideas. We want to show opportunities, and that's what we share today. Options do involve risk and may not be suitable for all investors. Now, today we showcased the portfolio tools. We showed a little bit of the profit and loss chart. We went into the historical search and historical search by symbol briefly to look up the positions for Barry. But if you like some of those tools you saw today or want to delve into the search tools and 23 different strategies to find the positions that match your personal risk-reward tolerance, remember, just go to powerop.com at any time. Just put in your name and email address. You'll have full access to the site for 14 days. Patented search tools. You can use our defaults as a stepping stone or create your own personal search. You got those historical tools that you can use during the trial, 3 months of back testing. Portfolio tools for tracking and managing and evaluating rollout opportunities, and more. Plus, no credit card is required. It is completely free. Just name and email address. The trial just expires naturally after 14 days. After that, the subscriptions start at only $45 per month for the end-of-day data service. But the 20-minute delayed service, our most popular level of subscription, is only $65 per month. And then the historical upgrade so that you can get the full several years of historical backtesting access for search tools, search by symbol, and that historical option chain. That's just $100. Gives you everything that you've got on 20-minute delayed, 15-minute delayed service, plus the multiple years of historical access. And we do offer a real-time service, of course, as well. You can cancel your subscription at any time. There's no contractual obligation. Coaching sessions are available on all levels of subscription. It's essentially a 35 to 45-minute phone conversation with myself or Ernie. You could, of course, upgrade at any time as well, and you have full access to the webinar archives as a full subscriber. Speaking of that, other education, you can go at any time to poweropt.com/webinars.asp and scroll through the various archived webinars we have. Not all of them are available to non-subscribers, but 90% of them are. Just some of the most recent ones aren't available for full subscribers. I'm sorry, aren't available for anyone but a full subscriber. But of course, you also check us out on YouTube. Go to YouTube, look up PowerOptions. We showed that earlier today. We're looking for that other presentation on the out-of-the-money covered calls concept from Mikhail and David. Now, if you think of any other questions later on, remember you can send me an email at any time to support@poweropt.com or to support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. And of course, trial members and subscribers, you can schedule one of those coaching sessions at any time.